Hi, everyone, and welcome to our mid-year webcast. I want to talk a little bit about the first half of the year and what we have seen happening in the market, and then draw the conclusions on how we are navigating the second half of the year and potentially also 2026. So I would say in the first half of the year, there's been a few developments which appear to create a different picture for financial markets compared to what we're used to, especially what we're used to in the post-quantitative easing period. Firstly, we have a reemergence of geopolitical risk with the Trump administration using tariff policy as a means of negotiation internationally. But at the same time, we also have persistent fiscal spending and persistent monetary easing. The main policy tools which continue to be key tools for investors. And so in a way, we have reiterated also in our last April webcast that the tariff policy was a bit of a distraction and that investors should look at fiscal policy and monetary policy, which continue to be loose both in the US as well as in Europe. However, towards the second part of the year, we're probably going to see more bottlenecks across both fiscal tools and monetary tools. In other words, we already see that governments in the West, in particular, are experiencing difficulties in spending, and the term premium for government bonds in the long end is rising, and that central banks are experiencing some dilemmas. In other words, inflation is more persistent than they expected, and therefore continuing to cut rates is becoming more challenging. The result is a very interesting, very attractive opportunity set for credit markets, where volatility comes back. It doesn't come back for a long time. We'll talk about how and how frequently. And dispersion is also increasing. So a lot of names which in the past were saved by injections of capital, by amends and extends and kicking the cans, are now having more difficulty refinancing over and over. And especially across these names are very large, very popular capital structures. So going into the second half of the year, we continue to stand by these 5 key investment principles, which we highlighted over the past few months. The first one is investing alongside governments. Governments will continue to support some key industries and sectors, and having support not just from fiscal spending per se, but also consolidation would be very important, both in credit and also in the equity space. For example, Europe is consolidating banks, but also telecoms, the space sector, and infrastructure. So in these sectors in particular, investors will have both the support from fiscal spending as well as the support of consolidation and synergies. As a result of fiscal spending, we'll probably have also persistent inflation. Even though the recent inflation numbers are slowing, there is a composition issue, and Tao will talk about this later on as well. We want to make sure that returns here are linked to cash flows and that companies have pricing powers compared to customers. The third point is diversifying to the rest of the world. The world is too long US assets. There's growth outside, and other assets outside of the US are often underowned. Other 2 points. Duration is not a safe haven. Government debt will become more correlated to risk, as it's already happened in the past few months. And finally, staying liquid is very important. Staying in assets that can be traded, that can be sold. The opportunity cost of not doing that is really high, and we've done some work on this as well. So on the first point, investing alongside governments, what I want to say is that we already know that the deficit numbers are pretty high in the US. Most important piece of news, I think, over the last few months was not the tariffs, but the debt ceiling and the tax deal, which includes more spending with the CBO forecast, even higher than last year. So we have a pretty high deficit trajectory. This spending will obviously go into certain sectors, and we need to make sure that when we invest, we want to be in those sectors, essentially. So investing alongside governments. In Europe, it's a little bit more clear because Europe is investing more closely into defense and infrastructure, and this is a game-changing plan. Germany waited 20 years to implement it, so we're looking at over $1 trillion of spending. There's a lot of skepticism, but this is actually, it is happening, and we do see that companies have already ramped up the capacity across, for example, defense, across industrials. Some industrial companies are being offered to repurpose some of their plants, Volkswagen in Germany and Renault in France, for example. And it's spreading across Europe. Germany, obviously, it is the biggest spender, but also other countries in Europe are benefiting. So deficits continue, and it's better to be on the right side of governments. Other countries will have less fiscal space. You've seen the UK budget earlier. The UK is one example of a country that has slightly smaller fiscal space, and as a result, there will have to be some cuts to other areas. So I would say that the winners here are sectors that are linked to government spending, so infrastructure, defense, sectors that are strategic like telecoms or banks or space, for example. The losers are sectors that are linked to the consumer and discretionary spending, because the consumer will get hurt by higher taxes. So that's a key principle, I think, going into the second half of the year, to look at sector positioning and what is happening within the market. Where can the risks come from? Well, obviously, all this government spending comes at a cost, and we have a lot of supply of government debt coming into the second half. Now, so far, we have seen central banks relatively dovish. Central banks have accompanied this government spending with an expansion of their balance sheet. We have seen quantitative tightening, but there's increasing discussions about reducing the pace of quantitative tightening, especially, for example, in the UK, but also dovish discussions in the US. We have learned that Scott Bessent is a potential candidate for the Federal Reserve chair role, and that might be something that makes the Federal Reserve even more aware of the long end of the curve. So we might go into a situation where central bank balance sheets expand again, which is something that we talked about for a long time. We called it QE infinity a long time ago. It's very hard for central banks to get out of quantitative easing once they have started. And so right now we see that central banks have reduced their balance sheet compared to GDP, but actually the Federal Reserve has been really active in controlling the long end of the curve. As a result, credit has remained stable on the overall market. There are moments of widening, but obviously currencies are depreciating, inflation stays persistent, and real upside is what really matters. So we see that, not just the dollar, but generally Western currencies gradually depreciate, and this is accelerating as governments continue to spend in this, geopolitical conflict with the east of the world. Is it right then to have a lot of assets in the Western world, especially in the US? Well, it's a risk, because right now we continue to see that gradually investors are diversifying, but there's a lot more talk about diversification outside of the US and into the rest of the world versus what is actually happening. So there is a lot of talk, but investors are still very overweight US assets. And as you can see here, that's a bit less true for treasuries. There's been sales of treasuries, especially from China, but there's been increasing overweight in equities and corporate bonds. In particular, if we look at the credit market and the CDS indices, we have close to the record high, all-time high, long risk positioning on CDX high yield, so the US high yield index, versus close to the record all-time short positioning in the European index. So there continues to be an over-allocation to US assets, even in light of this continued fiscal spending, high inflation, and central bank intervention, which eventually will cause a deterioration in the quality of the US government balance sheet, as we've seen from the rating agencies, and also in the quality of the safe haven asset. And this is the key to understand, I think, the next quarters, the next years, is we are used to investing with a safe haven asset and a negative correlation between risky assets and these safe haven assets, which is essentially treasuries. And this is now changing. It's changing because the fiscal room, the fiscal space of the US is being tested. And with that, also the fiscal space of other governments in the world that have limited room, limited hard resources, so limited commodities and limited resources to spend. Probably the case in point is the United Kingdom, where 50% of goods are imported, and GDP is heavily based on services and the top 1% of the wealthy population. So the correlation between risky assets and risk-free assets has gone back to positive. Post the 90s, this was also the case when inflation was anchored at a much higher level. Then we had a period of very stable inflation, of globalization, with China giving the US a very good deal, essentially exporting inexpensive goods to the US and the US being financed by China, China buying US Treasuries. The deal is now being restruck. So one of the consequences is that there's fewer people that want to buy US Treasuries. The US is spending more. And the real point of discussion is the potential rise in term premium in the long end of the curve. One question that we often see, that we often think about, and we have thought about a lot in the past few quarters, is how is it possible that, with the Fed hiking 500 basis points, we never had a default cycle. We didn't really have a recession. We had a few moments of volatility, but we never really had a big crisis. And the reason is we had, over the hiking period, and before the Fed started to cut, we had a lot of control of the long end of the curve. The US economy runs on the long end of the curve, unlike the European economy. And we also had persistent fiscal spending. In other words, the crisis that we have experienced in the market in the post-QE era have been very fast, very acute, but also very fast and very short-lived. And this chart here shows you the two standard deviation events across asset classes, and every bar is highlighting the duration of these events. So we have a period of calm from 2011 until 2020, and then we have increased government intervention, persistent deficits, and increased intervention of central banks into the market. There are a number of facilities that the Fed has been using post-2020 to intervene in the market and to calm volatility in the long end of the curve and across treasuries. So eventually, though, there is a fine line between well-functioning treasury market and yield curve control. And we are going towards potentially a restart, especially with the new Fed chair of these instruments. So what does this all mean? That it means that markets are more often in a scenario where volatility is suppressed and central banks are controlling the movements of the yield curve, and with rates volatility, they also control credit and equity volatility on top of that. And as a result of that, most of the time, credit markets are in a very complacent territory, I would say 60 or 70% of the time. But then you have situations which become interesting where something breaks in a sector, for example, like Credit Suisse and SVB 2 years ago, or, for example, in the travel sector with issues in the Middle East, or, for example, in the auto sector in Europe with competition from China. So you have dislocations that arise, which are highlighted in the chart we showed before, in this area chart. And when these dislocations arise, then credit markets become extremely attractive. The opportunity cost of staying in a strategy that is locked, that is long-term and does not move, is actually quite high. And the simple performance of a strategy that is able to capture dislocations, even with a simple rule, when dislocations arise, is much higher than a strategy which is buy and hold. So where are we now in credit markets? To conclude how we are operating in the world and how we use these 5 principles. We had a pretty tight spread environment at the start of the year. We started the year close to record lows and close to record longs in the US market. We had a different situation, a different setup in the European market with short positioning, better fundamentals, and slightly better valuations. Then the market was shocked by the tariffs, starting with some widening in March and more widening in April. And we captured this widening by monetizing some of our hedges and finding good assets, attractive assets, with support from shareholders, stakeholders, sometimes from governments, to buy during the month of April. Credit markets mostly recovered between April and today, between April and May, from the end of April until today, roughly to the tight levels where they were at the beginning of the year, or very close to that. So you can see here that the red dot is where we were in April, and today the white dot is very close to where we are, to where we were in January, and that's close to the or below the 10-year median of spreads over the past 10 years. So we're back to very tight levels. What do we want to do right now? Well, I think that the first half has been an example of this new world, this new world order, where we are going. I would say investors have not completely adjusted. We really like this opportunity set because there's both top-down volatility, and finally we're starting to see some of the largest capital structures that have in the past benefited from amend and extend, from private credit injections, which are still not sustainable, starting to disperse, starting to gradually get downgraded and go into stress. So we think that these windows of opportunity will come back and will continue. And in the second half, we might see more volatility, more dispersion, also linked to government spending and the long end of rates. So right now, I would say we have gone back to the positioning that we had at the beginning of the year. So we're cautious on credit, especially on US credit. We continue to like on relative value European credit versus US credit. We see stronger fundamentals in Europe, better valuations, and investors are not positioned long on European credit. While the opposite is true for US high yield, where fundamentals are more fragile, especially on cyclical names, valuations are really tight, and it is a crowded long. We do expect volatility to come back in the second half of the year. We also see dispersion coming back. We are not going into a distress cycle. We're not going into a large default cycle, but some of the companies that were able to get a bridge loan or an extension of 2 years in the hope that funding costs will come down are now seeing that this is not true. And it's not true because previously the Fed was holding the long end of the curve inverted. Now the Fed is cutting, but the long end of the curve is de-anchored and it's disinverting, it's steepening because of inflation and persistent government spending. So we have the long end of the curves, which stays high. And finally, if we look at the winners and losers, what we like, what we don't like, I would say that it's very important for investors to focus on where government spending will go. We are in an economy that's increasingly becoming more controlled in financial markets by central banks and more controlled in the real economy by government. So in Europe, that means being in sectors that will consolidate, like telecoms, infrastructure, and banks, and sectors that or defense, or sectors where government spending will go. On the other hand, consumers might be the slightly weaker spot, particularly in the US and the UK. And I would say those capital structures, those sectors which have relied on private funding or amend and extends will continue to be weak. So we're pretty happy about where we are right now. We've been up pretty much every month of the year, flat or up every month of the year. We've been able to navigate the volatility of the April sell-off, and we look forward. We are repositioning for potential further volatility. We continue to do relative value, but we are positioning for an environment where risk is changing and the relationships between asset classes are changing. And it's a pretty good setup for us. It's actually the reason why we want to be in this strategy compared to somewhere where you have a long bias. So I'm happy with that to turn it to any questions that can come, and also to Tao, who's on the line from our Singapore office. Okay, so there's one question about the US fiscal situation. So I think that, that's the end game. A lot of people are thinking about the long term, right? We are thinking a lot about the next months. The question is, how do we see the US fiscal situation being resolved over time? I think that, we don't know what the very long-term solution is. I would say there's a good outcome, which is growth. So we could have a positive, and we are not calling for the complete end of US exceptionalism, but a repricing of this exceptionalism. There's a lot of fear mongering. We are transitioning to a multipolar world. The US still has a lot of cards to play. So we're not bearish there. We'll be the first to buy US credit when it widens, let's say. In a few years in the past, we had a lot of good buys there. The problem, though, is that we have a very tight credit market with a safe haven asset underneath that's becoming less safe. And investors globally, China, first of all, are diversifying out of US Treasuries. So typically, you can have a positive growth shock, and that can be with technology, for example, with AI, or you can have persistent inflation and low real rate. So essentially, the amount of public debt gets absorbed by inflation. So in other words, we don't like treasuries at 4% because the realized level of inflation will be high. I would say that we can also look at this in a slightly different view from the eyes of China. China went from 5% of global manufacturing to 30% over the last 2 decades. So in some ways, China has already been winning, winning slowly the economic war, not the military war. And China's incentive is not to go into a military war because that could potentially turn the tide the other way, because the US is already is stronger and the Western world is stronger. But in a slow way, China is already winning. And in the past, China was funding the US and it was also exporting goods to the US, which were keeping inflation really low and allowing consumers to borrow and to spend and to feel good without real incomes going up, and corporates to pay dividends without raising real wages. So this equilibrium, this US exceptionalism, has been based in a way on the work that China has done, and this is now being restruck. So I would say that in credit, when spreads are at the lows, there's limited upside. So it's much better to be in a market that has more upside, that has a bit more risk priced in, like Europe, and leave the US market right now for better entry points. In the equity market, you can argue either way. You can argue whether you want to be in US equities because there's more growth, more upside, more technology, or whether you want to do a value trade in Europe. But in credit, the equation is relatively simple. In terms of capital flows, there is a second question on capital flows between the US and the EU. And what we are seeing from data points, and Tao, I'll leave it to you now, is that there's been a lot of discussions around diversification, but the capital flows continue to be slow. So there's been relatively slow reallocations out of the US and into Europe. And anecdotally, we know that there's a bit more, but we're still in the early stage of this allocation. And probably what we have seen so far is investors in the US and in Europe allocating to their domestic economies rather than allocating to the US.
Yeah, I think to add on to Alberto, from data we track, basically we are seeing more inflows into European high yield and IG in credit in terms of ETFs and also mutual funds. It has been more positive in recent months, but if you look at an over longer period of time, from year to date or even for the past few years, it is still very small. And there is definitely more room to grow. And on the other hand, this is about cash credit. On the other side, if we look at the credit indices, CDS indices, in terms of the US high yield, CDX high yield versus iTraxx crossover, there is still like a very much overweight in CDX high yield versus underweight in crossover, which is still very often used by credit investors as a hedging instrument. So there is definitely more room to go.
Again, we have often talked about this diversification in the past few years, but like right now, it seems like the large investors are moving and definitely haven't moved yet. So I think we are good with questions, and we're also close to half an hour. We want to keep this short and sweet for everyone. I would like to thank everyone for being with us in the first half of the year and navigating this market. We're very happy to answer any more questions bilaterally, and we wish you good luck for the second half of the year. Please stay tuned with us, with the Silver Bullet and future webcasts, and good luck for the second half of the year. Thank you.